In July of 2018, the third version of President Obama's Jobs Act was passed to make it finally possible for average Americans to invest directly into startups and small business. Previously only available to people with high incomes, small business investment is a first step to truly democratizing access to economic opportunity. It has also allowed platforms like Crowdfund Mainstreet to help early-stage, mission-driven businesses get access to investors looking to invest in local, impactful business. Tune in to hear more from Crowdfund Mainstreet CEO Michelle Thimesch as she explains their mission and vision. Hello, everybody, to another episode of Life by the Numbers. This is Shingai, and I'm joined here today by one of the co-founders of Crowdfund Mainstreet, Michelle Thimesch. Welcome, Michelle. Thanks for joining us.
Thank you for having me.
So one of the big topics of Oakland, of the Bay Area, of entrepreneurship in general, is the rise and emergence of social entrepreneurship and mission-driven companies. And I know that Crowdfund Mainstreet is really well positioned to kind of create that marketplace for mission-driven companies. Can you tell us more about what Crowdfund Mainstreet is and what you do and how you work with social entrepreneurs?
Sure. Crowdfund Mainstreet actually focuses on what has always been there in America, the American ingenuity, the unsung entrepreneurial heroes that we have in our country, who often are the people who care about their local communities and fixing problems within industries or addressing the social and economic justice that we see. The reason that we haven't seen many of these businesses of late is because the financing for these companies has all but dried up. And entrepreneurship is actually going through a decline. The reason it is not because we lack those innovations and those ideas, it's because of the funding. So Crowdfund Mainstreet was established to really focus on those businesses that are not in it just for the money. There's nothing wrong with wanting to make a living. There's nothing wrong with wanting to supply your employees with a living wage. And we have many of those companies. The thing that Crowdfund Mainstreet does is it allows us to highlight those kinds of companies to show that these are economically viable enterprises, and to also open up the marketplace for what we call Main Street investors.
So you mentioned that you observed a decline in entrepreneurship. Is that in the sense of companies not getting funding, or is it also just a decline in the number of people that are starting new businesses?
There is a decline, a definite decline in funding. Funding is a huge problem in our country. There is also a disincentive to go into business when you realize the landscape makes it so difficult. But even though it is discouraging, we still have about 100,000 businesses that start every month in this country.
Mm-hmm. So that's an incredible opportunity that, you know, a lot of people aren't really aware of, or, you know, there's a big delta then. If there are 100,000 new companies, do you have a sense of how many companies typically get funding per year?
Yeah, well, as you probably know, the venture capital marketplace is probably the most popular place to go for private funding, private equity funding. So to put it in perspective, they funded the $84 billion that was put into the marketplace by venture capital last year, totaled $84 billion. Mm-hmm. That is a large sum of money. It went to just over 8,000 enterprises. Wow. So if you look at how many of the 100,000 companies that are launching every month, that just shows you the minuscule amount of companies that are getting funded. On top of that, if you look at women and minorities, they get even less of a percentage of that money. So it's no mystery why the landscape is the way it is in terms of funding.
Yeah, yeah. And what kind of impact do you see that funding have on the types of businesses that get funding?
Right. So there's venture capitalists focus on, it's their business model. They focus on very, very high growth, very fast growth companies. The problem with that is that even a VC will tell you, you have to invest in quite a few failures so that you can hit the occasional home run. If you look at what VCs make on average, it's a loss. That's why it's so critical for them to hit home runs. The problem is very few businesses are set up or designed to have that kind of exponential growth. In fact, many would argue that that's some of the reason that businesses fail, is the wrong kind of money with the wrong kind of pressure.
Yeah.
Most businesses need to grow a little bit more organically, a little bit slower.
Mm-hmm. I mean, I've personally experienced that in the healthcare space where, and I think healthcare, life sciences, that's one big industry where you need a lot of R&D because of regulatory requirements and just because of, needing the science to prove what you have. And I know that VCs tended to be averse to investing early stage, typically Series B or beyond. From the standpoint of where you're looking, what phase of the life cycle do you typically invest in, or you typically connect companies with financing?
Yeah, that's a really good question. We have everything from pre-revenue companies who have maybe existed for 3 years, but still have not generated that first nickel in their business because it happens to be a cash intensive endeavor where they need a large infusion of capital, all the way to businesses that have been in operation for decades, but just can't seem to get to that next level because they need an infusion of capital.
Yeah. So what is the high level change that you're seeking to bring when it comes to the different types of businesses that you're helping to get investment?
Yeah, the high level change is really the types of businesses that are postured to do well and to do good. Mm-hmm. So when you look at our multinational companies, for example, the loyalty to the bottom line, and in fact, legally they're compelled. If you're a C corporation, for example, you are beholden to your shareholders. You have to be focused on the bottom line for those people. And it's no mystery why we've gotten into sort of the crony capitalism that prevails in our marketplace, because that is legally what companies are structured to do. So there are a lot of new changes. There's a movement in the B Corp, public benefit corporations. A lot of companies are realizing that in addition to making money and returns for investors and shareholders, that in addition to that, we can be focusing on problems that need to be solved, and that we can structure our entities in such a way that allows us to do that.
Yeah. So what's an example of that?
So an example, Crowdfund Mainstreet, for example, is a public benefit corporation. Mm-hmm. So we're not quite eligible yet, but we are in the process of beginning to apply for B Corp status. And what that allows us to do is it allows us to say to our shareholders that as much as we are interested in paying you dividends, we are also interested in fixing what's wrong in our marketplace, accessing, in our case, entrepreneurs who wouldn't otherwise have access to the kinds of tools that they need to learn how to raise capital. Mm-hmm. So that add-on, that give back component, if you will, which in some ways isn't the least bit charitable because it's a tide that lifts all boats. Right. Yeah.
So that's interesting. What kind of response have you seen? I mean, is this something that people are receptive to or open to, or do they see it as like something that's weird and foreign?
People are extremely open to it, but because there hasn't been a tool, mm-hmm. We've been talking about impact investing and these kinds of things, social and economic justice, for decades. But what I'm finding is that because there's so much talk, and that's really all that anybody's been doing, that we are stuck a little bit in talk mode, and that when it comes to actions and the steps that we need to take to implement a marketplace, mm-hmm. people are a little bit weary. They don't understand what they themselves can do and how that little bit of action on their part can make a huge difference.
Yeah. So what are the steps that you are working on to help educate people or try to bring them along with you, kicking or screaming or willingly?
Yeah. I mean, as an advocate, my background as an attorney, I guess there'll always be a bit of advocate in me.
Hmm.
I, I'm one of the things that people don't realize is that because of our rules about who can invest in what, namely the accredited investor rule, I believe that there's a constitutionality component to that. So, for example, we have a financial system that actually limits who can invest in a particular asset class. Up until very recently, the Jobs Act, regular people, Mainstreet investors, I call them, have not had the opportunity to participate in small business as an asset class. So, stocks, bonds, mutual funds, CDs, those are all asset classes.
Hmm.
And the very wealthy have long participated in small business and startups as an asset class. And to some extent, you can participate if you know how. But most people who are not wealthy have been boxed out of that. So what would it be like if it were illegal for me to buy stocks in an S&P 500 company? It's not different from boxing out somebody from the ability to use a small business and investing in small business as a way to grow my wealth by investing in those companies. So to me, it's actually a civil right, a constitutional argument that the basic tenet of our country is that every individual has access to equal opportunities. And it's just not been the case in our financial system.
So that makes a lot of sense. Playing devil's advocate, I remember I was about, I think 13 or so at the time when the dot-com crash happened. And a lot of the commentary around that time, actually very similar to, I think it was the 2016 crash in the Chinese stock market, where you have a huge population of people who are kind of first-time investors who don't necessarily have a lot of knowledge in the assets and in the tools that are being, oftentimes you have predatory brokers, et cetera, that are getting people to invest, a lot of pump and dump, et cetera. Then the stock market crashes, and then you have essentially a whole generation of people that have a significant amount of their wealth wiped out. So so I'm not arguing the constitutionality at all. What are the safeguards that a Main Street investor will have against sort of the frauds and the charlatans that abound within the financial space?
In the circumstances that you are talking about, the individual investor is not part of the decision-making process. The individual investor in those cases is relying on a third party, a third party who, by all accounts, in most cases, will fully admit that your money and your financial security is not their primary goal. Mm-hmm. Whereas if you take a Main Street investor who is self-directed, somebody who's making their own decisions about whether they're vetting a fund or whether they're actually investing in private companies themselves, which of course a platform like Crowdfund Mainstreet allows people to do like never before, then you are introducing a whole new component. People are not smarter or better because they're wealthier. Every individual has the ability to decide for themselves what is important to them and what they would like their money to get behind.
So your focus is on essentially providing, so not only the platform to actually invest in the companies, but also the means for people to do their diligence on the companies themselves, and sort of on a first-hand basis as opposed to through somebody else.
Yeah, and one of the things, this is a highly regulated, regulation crowdfunding is one of the most highly regulated because it does allow for non-accredited investors to participate. Mm-hmm. And the advantage of being highly regulated is that any company that comes on the platform is bearing their soul. They have reviewed financials. The disclosures are such that really don't exist oftentimes in the marketplace of the vetting of small businesses and startups. So from that standpoint, it's a very, very high level of scrutiny, which gives people the comfort of knowing that, wow, these companies have actually been through quite a bit to even be on the platform.
That makes sense. From an ecosystem standpoint, so it sounds like you have a lot of the pieces already lined up. So first question there is, do you have a location center for now, or is this pretty much anybody anywhere in the US can participate?
Yeah, right now we just so happen to have 6 California companies.
Mhm.
5 are located in Oakland, which is why we launched at a live event last month. All it takes is a US-based company to raise capital. We actually are focused on wanting to fill in the middle ultimately as the platform grows and as the investor base goes. We believe we can move into middle America and really start fixing some of the communities that have been lagging since the days of the Industrial Revolution.
So when you say moving into middle America, is this more about having companies that can either sell products or provide services to middle America, or are you talking about driving the economic benefits of these companies towards middle America, or both?
Really both, as well as opening up the possibility for communities taking control of the kind of enterprise that they recognize needs. No one knows their community like a community.
Yeah.
And if you go across this country, I wrote an article recently called, America the Ugly.
Yeah.
For the reason that if you go outside of our bubble here in the Bay Area, it's really easy to see that you could be in St. George, Utah, for example, and not know that it's any different from a city in Kansas, because all there is are multinational chains that make up the entire community. Yeah. They all look the same. So that's not something that communities are looking forward to and that communities want to have happen. They'd love to see their little downtowns and their entrepreneurs that are local be able to get into the marketplace and serve their communities.
So what's the growth strategy? So right now you said you have 6 companies in California, 5 in Oakland. I know that social entrepreneurship as sort of an industry seems to be centered in Oakland. So I imagine that there's a lot of growth here locally. But how do you imagine essentially kind of creating those rings of concentric circles that go out and further into middle America?
Yeah, it's quite a challenge. We're not, I tell people, they think we're not dipping our toe in an existing marketplace. We're actually creating a marketplace. So it's a long view. It's definitely a long view. But every time we have an investor who reviews a company on the platform and maybe comments or engages with the company who's raising money, whether or not they decide to invest is almost irrelevant. The important thing is that people are aware of this opportunity. So our task is to get the word out about the fact that these opportunities exist.
Mm-hmm. Do you have specific industries that you focus on? So I guess how are you defining the mission-driven aspect? Are you focusing on, is this a public benefit company, or at this point is it really about, do you kind of vet companies that come on to assess whether or not they really are aligned with your focus?
Yes, we definitely have a vetting process. Companies go through an application and an interview process before they can launch on the platform. What we look at is a lot of what you would think we would look at: the founders, their backgrounds, what are the teams that they're building, what do their financials look like, what do their projections look like, does the strategy that they're using to raise capital make sense given all of those things? Are they taking an off-the-shelf cookie-cutter document to try to raise capital that they don't even understand? Or have they actually taken the time and the trouble to figure out what makes the most sense for what they want for their future, as well as their investors, and how they're going to pay them back?
Yeah. So how do you see the growth of the number of companies at this point that meet that initial hurdle and start to raise on your platform?
Many companies meet the criteria. Oftentimes the companies will have been through some sort of incubation program, or they will have an attorney who is well-versed in the space of capital raising. Where we find the lagging behind is really in how do you put together an actual public offering. A crowdfunding campaign is a public offering. And there is some work that needs to be done if you're going to be successful in leveraging your own community and things of that nature. That's where we see people needing a lot of support.
Mm-hmm. So one interesting thought came to my mind. So just thinking about the companies as they move onto your platform and they start raising money from Mainstreet investors, one of the benefits of a VC or angel type model is because you have fewer investors. Theoretically, if you have good investors, they have the ability to provide support either from a networking perspective or from a subject matter expertise perspective. When you start having a more diffuse investor base, even if you have people that do have that expertise, it becomes really difficult. Imagine an investor call with 30 investors. What is that process as companies evolve? They've already raised their money and they're starting to evolve and engage with their shareholders, engage with their customers. What kinds of processes do you have in place to make sure that companies can take investor feedback, they can get advice from investors as need be, and they can make sure that they're serving their mission, but also ensuring that their investors are happy too?
Mm-hmm. It's a really good question. One thing that we found, and I've been working in this space offline, even though the platform has been helping small businesses for a couple decades. And one of the things that has really emerged as a truth is that it's very difficult to combine the right money with the right expertise. And in fact, one of the things that I've long advocated is that separate them. If you are properly capitalized, you're going to be able to afford the expertise that you need, and you're going to be able to vet that expertise. And that expertise is not necessarily going to be one of your investors. It may, but there's no reason that those things have to come in the same package. And in fact, there's a lot to be said for separating them.
Okay, no, that's fair. So can you go into that a little bit more?
Sure. Every company, especially a company that's going to craft an offering that's really suited to their growth, their path, they may be able to attract an investor who maybe that's something that they're interested in, but aren't going to participate at a level that would make them need to be a part of that on a day-to-day basis. Maybe it's just a small fraction of their portfolio and they really wouldn't even have had the time to devote to that company. But they're still interested in these founders. They still really respect what they're doing and see a need for it. Then they believe that money is going to be stewarded appropriately without being involved. And if that money can buy some expertise for that company, then they're going to be assured that the money, you can't do everything. You can't be everywhere. So one of the things that this does by separating is it allows, like we often see in real estate, where we see that the expertise is left to the company and their advisors who they've retained, and that the investor plays a little bit more passive role, although certainly depending on their status as an investor, they may have an equity interest, they may not. They may just be holding debt.
Yeah. And from that standpoint, you have a range of arrangements that investors can take there?
The sky's the limit. As long as it is legal, there's very little that you can't do in terms of creativity. And oftentimes the entrepreneurs that we work with, you'll see the creativity in the offering themselves, in the offerings, because if you're grabbing an off-the-shelf instrument that you yourself don't even understand, whether that's convertible debt or a safe or some other instrument, just because it's available to you and you yourself don't understand it, it's a mystery to me how you're going to steward that investor's position and capital if you haven't taken the time to evaluate that instrument with respect to your goals and values and how you are going to exit either yourself or just your investor.
Yeah. So what is that process? Because I imagine that a lot of startup founders, especially if their expertise is in, whatever field it is, maybe ocean cleanup, maybe healthcare, a lot of them aren't going to have that expertise to understand these different models. what is that education process that you don't
Yeah.
walk them through? Or
It's actually really fun, even though most of them don't have the expertise to draft the documents that you need to implement those kinds of deals. They never lack ideas about how the capital infusion is going to play out in their particular company. And, they might say, I'm just not sure when I'll be able to start paying back, but I'm looking at my projections, and it looks like if I did something, say, like a revenue share instrument, where the investor gets a percentage of my gross revenue until they've reached a multiple, maybe 1.5%, that's how I know when I will have paid them back. Then that can really inform how they talk to investors and what the investors' expectations are, because it's not the pressure of this exact amount that I'm getting. In fact, my return in that situation is a factor of how fast things happened, but I can still predict what an internal rate of return would be given my financial projections. And companies love that kind of creativity.
Okay. So, and I imagine that a lot of people, especially people in the Bay, are bombarded with, convertible debt, safe, as, the way to do things as a startup. What is that process of helping people kind of open up the purse strings, or not purse strings, but sort of open up the inflexibility or imagination to kind of think about these different types of models?
Yeah, we find it really starts with empowering the issuer. The person who's raising capital is called an issuer because they're issuing securities,
Mm-hmm.
right? So the companies, and we really find that once they understand what they're doing and how it's impacting the investor and what it is that they're offering the investors, that they can engage very articulately about what that investor might be able to expect. And then the investor is able to ask really intelligent questions about, well, maybe this is what they've seen in the past, and how is this different? And then an issuer who's been educated can actually speak about those things and as it relates to their particular business.
Okay. So from the standpoint of the growth of your ecosystem, what do you see in the next, say, 6 months and in the next 12 months in terms of who you bring onto the platform, either advisors, investors, companies, et cetera?
Yeah, really good question. We're talking right now to a lot of cities and a lot of small business development centers, a lot of incubators. The one thing that happens in all of those places, it doesn't matter how good your Mainstreet initiative is, it doesn't matter how good your incubator is. If you don't have a place to send those deals to get capital, if you don't have a place to go to fund that venture, they don't get off the ground. And what we're realizing is that we've got housing initiatives, for example, here in the Bay Area, affordable housing initiatives, that we've got people who've kind of figured out how we would increase the inventory of affordable housing. The question is, how do those ventures get funded? Mm-hmm. And one of the ways that those can get started, we believe, is by raising money from the community itself.
Mm-hmm. So it's almost a financial activism type.
Absolutely.
Yeah.
Absolutely. Yes.
So I think that's really exciting. In terms of a call to action to the audience, what are some things that somebody who's watching this or listening, who's interested, can contribute or help?
What would be really great is if people went to crowdfundmainstreet.com, the platform itself, and engaged with at least one of those companies. Review the campaign, look at the offering, and even if there isn't an interest in investing, if there's a company that you feel like you'd like to ask a question of, opening up that discussion would be really helpful. And also would open your eyes about the kinds of companies that are actually looking for funding in the marketplace. And that is a great first step, whether you're looking to raise capital yourself or whether you're looking at what are the different ways that I might be able to grow wealth in my own portfolio.
Mm-hmm. I think that's a solid call to action. I think this is a really good timing because I think that the stock market's getting stretched a bit thin. We're probably on the brink of something. Who knows? So, what better place to invest than within your own community, within companies that are actually solving positive problems?
Exactly. Exactly.
Well, thank you, Michelle, for joining us. For those watching, again, it's crowdfundmainstreet.com. Check it out. Like she said, engage with some of the companies, check out what they're doing. If you're in the Bay Area, do you have events coming up?
We do. We often have events. This Sunday, one of the issuers on the platform is hosting a wine talk. Her business is in the wine industry. So following us on social media, we're always posting the different webinars or in-person events that the issuers are going to be speaking at.
Okay, awesome. So there's a lot to engage with these guys. So um, do it. It's in the best interest of the community.
Exactly.
Thanks again for joining us, Michelle.
Thank you.